Now, at this point, I'm assuming that you now understand price action with in-depth knowledge, right? Now you are able to read candlesticks, trends, support and resistance. Now, in the coming lessons, let me show you how we can also add technical indicators to create good strategies, combining them with those price action patterns that we have been talking about. So this way we are trying to get the best out of any situation that we get into the market. So we are trying to come up with like 3, 4 or 5 strategies that you can be using in the market. That way, any day, anytime, you are going to get a trade. So the strategy that I'm gonna start by showing you here is the moving average plus breakout strategy, right? So I'm gonna show you how to use this strategy. So this strategy, just like any other strategy that we do, we want to first know the conditions of the market, right? So we have the conditions, or we can call the direction. We can call the So we can say this is the conditions, and we want to also know the entry rules of the strategy. We also want to know when do we exit the strategy, right? So first of all, what are the conditions of this strategy? So as you can see, I've plotted 2 moving averages here. The red one is the 50 exponential moving average, and the blue one is the 20 exponential moving average, right? So these 2 indicators are going to be helping us to filter the trend, right? So before I do that, let me explain a little bit how the moving average is created and why do we use it to filter the trend. So the moving average calculates the average movement of the past candles of any selected period. So for us saying this is the 50 EMA, it simply means this moving average is calculating the average movement or the average closing prices or the opening price, whatever you select, because you select open or close or high, low, middle, whatever. So let's say you are selecting close, that's the default, right? So it calculates the closing prices of the past 50 candles and then it adds the past 50 candles and then divide them by 50, just like an average of anything. So you know how to calculate averages. Let's say you want the average of moving average period 5, right? You take the closing price of the last 5 candles and then you add them up and then you divide it by 5, because it's called the 5 period moving average, right? So you don't even need to know how to calculate this. If you want to, let me just show you. So let's say the first candle closes let's say at $2, right? The third candle so the second candle closes at $3, the third candle closes at $4, and then the fourth candle closes at $5. So if let's say the fifth candle closes here at $6, so we'll be adding 2 plus 3 5 plus 4 9 plus 5 we have 14 plus 6 we have 20, right? So we get 20, and then we divide this by 5, we will get 4 as our average of this period, these 5 candles, right? These closing prices. So the average closing prices of it was 4, because we had closing it down here at 3 and 2 and also 5 and 6, right? So don't confuse with this. You don't even need to really get it, but you just want to know that the bigger the period, the bigger the period, the further the moving average is gonna be from the further the moving average is gonna be from the candles, right? So if my voice is not sounding the best today, you just go to forgive me a little bit because I had some flu, but I'm just trying to make sure that I give you these very good lessons as I still have all these things in mind, right? So the further the moving average is from the candle, then the further away the moving average is. So if you are calculating the moving average for 2 period, it's going to be coming very close into the candles because it's just calculating the average of each and every 2 candles, right? But at the same time, if you are calculating for 200 candles, it can move further away from the candles because for you to get it's combining a lot of candles right here in the market, right? So here's how you use the moving average. Number one, you can use the moving average to determine trend. Why do we say you can use it to determine trend? It's because what happens here is that the moving average follows. It's a lagging indicator and it follows once the market have already closed. So it's going to be following where the market is going, right? So the market goes first and the moving average follows. So if the moving average follows, you want to make sure that if it is below, if the moving average is above the price is in a downtrend. And if the moving average is above the is below the price, then the price is in an uptrend. But with all this, you also need to understand that the best way to identify these trends is using 2 moving averages or more, right? And then with the order of these moving average from small to the larger one, you want to make sure that they follow each other in that order, right? So that way you are going to get a stronger trend. So for example, if you see here, you are going to see that here we have the 50 moving average here, and here we have the 20. And the good thing is all these are following each other and they are headed to the downside. So if the 20 is below the 50, that simply means we are in a downtrend. If we go in an uptrend, let me show you. If we go in an uptrend, you are going to see that if the market is in an uptrend, the moving average are going to be changing in the order, right? So now we have the 20 being above the 50. This is the 20, the blue one, and this is the 50. And now we can see that the market is moving in an uptrend. That's how you use the moving averages in the best way. So now let's look at our strategy itself. So we said the first condition of this strategy is that the condition. So our first condition is that we want to see the 20 period moving average being below the 50 moving average, and this way we know that we are in a downtrend. And if we are in a downtrend, automatically we are looking to sell, and you know that, right? So the second condition that we want to see is that we want to see the market, we want to see price pulling back to the 20 EMA, but not close above the 50. So we say but not close above the 50 EMA. Number 3 condition that we want to see here is that there is gap between the moving averages. Now, once we see this, there's one more condition that we want to see, but don't worry, there are not a lot of conditions here, but these 3 conditions, if they line up, now you are objective in the market. There is no point of guessing at this point. So once we see this, we also want to make sure that we want now the market. So for our entry, we want the market to break previous level. So if you want, you can take a screenshot of these conditions, and then I will show you the exact example in this chart that we are looking at in the market. Okay, so now assuming that you have taken a screenshot, I'm going to explain this one by one as we are putting into the market. So if you look into this market, you can look from this point right here. We see the market moving lower, pulling back into this market, and then now we have the 50 EMA above the 20 EMA. If we have the 50 above the 20, now we know that we are in a downtrend. We are now seeing a pullback that comes into the 20 EMA but not close above the 50, and now we see the market moving down, and then it breaks past this previous zone right here. That's when we enter our, let's say, our sell trades. Okay, did you really understand this? Okay, I said first we want to see the market, these two moving averages going to the downside, the 50 being above and the 20 being below. And then we want to see the market pulling back into one of these moving averages and then going down. So if we this was the first example, this is the second example. We want to see the market moving down here like this, pulling back into this zone, and then we can see these moving averages. This is the 50, this is the 20. They are in their order, right? And then we see the market going down, and then we are waiting for the market to break past this zone with momentum. The first candle that breaks here, we want to sell right here, and we will put our stop loss above this sell candle, and our take profit should be 1.5 against the 1.5 risk to reward ratio. So you might be asking, why did I put these numbers 1.1, 1.5 to 1? Okay, what happens here is this is a breakout strategy. So after every breakout, the market will always seek to, it will move in mostly into this in the side of the breakout, but it will seek to make a reversal, right? So on the testing that we did on this strategy, we find out that when we wanted to use 2 to 1, 3 to 1, this strategy was having a lot of losing trades. But when we researched and when we tested this strategy using 1 to 1.5 risk to reward ratio, we managed to get a 55% win rate plus 1.15 risk, 1.5 to 1 risk to reward ratio, which gives you a very high, huge return on your account, because first of all, you are in profit already, you have an edge, right? Number two, you also have an edge of risk to reward ratio, right? So this is, but if you want to go for 2 to 1, you can try, but you need to test in another market. So we tested this strategy on synthetic indices, almost all of them, and the results were not far much different. We also tested on another indexes that trends. This is a trend breakout strategy, so you need instruments that trends. So when we tested this on another instruments in the forex market, it was like the currencies doesn't trend that much, so this strategy wouldn't perform very well. But if you trade it on crypto, if you trade it on indexes like Nasdaq, US 30, all those indices that moves very much, you can get good risk to reward ratio and good winning trades here. So let me show you another examples for the buy trades, right? So it's good to understand how we are talking about this, right? So here is an example of a buy trade which didn't go very well, but I wanted to show you this so that you understand the concept, right? So first we see the 50 EMA and the 20 are in this order, the 20 above the 50, right? Knowing that we are in an uptrend, we see the market moving above all these moving averages, and we see a pullback into the 20 EMA. Now we are marking out this zone, and we wait for the candle that breaks out. So it breaks out. This is the breakout candle that breaks above this previous zone, this previous higher high, and then this is where you want to buy. At this point, you are going to buy here. Put your stop loss below this breakout candle, right? A few pips below this breakout candle. But in this case, you can see the market eats up your stop loss, but then went on to go above. So this trade didn't really work well. But the point is, it doesn't matter how many trades you are going to win in the market. You are not going to win 100% of your trades. I wanted you to understand clearly how this strategy works, right? So there is a lot of examples that I can show you here. So here is another good example, right? Firstly, we see the 50 moving average is up here, and the 20 is up here, is down here, right? So we are in a downtrend. Number two, we see the market moving down here, making a pullback into these moving averages. But this trade was not gonna stand because the market went on to close above the 50. So once the market closes above the 50 here, the trend doesn't work. We wait again for the market to go below the both of the moving averages and start looking for another trade. In this case, it did right after that. It went below here. It makes a pullback. Now we have the 50 and the 20 in this order, showing a downtrend. Once it shows a downtrend, the next thing is the market pulls back into the 20, doesn't go to the 50 and moves down, and we are waiting for the breakout of this previous zone. So this was the lower low. So once it breaks out, this was your sell position. Put your stop loss above this candle. So here was going to be your stop loss, and your take profit 1.5 times the risk, which was going to be a very good winning trade, right? But note that here we didn't place the trade. Why? Because one of the conditions was broken. Because once the market closes above all these candles, all these moving averages, you might be starting a new uptrend, right? So that's another strategy that you can use. You can see a lot of examples in this market here. Let's take a look at one more example. We see the 50 here, the 20 here moving up. That means we are in an uptrend. We see the market moving up, breaks past here. We mark this zone and wait for the next opportunity when the market goes up and breaks past this zone. But also make sure there is no candle that closes below the 50. Here, this candle doesn't close, just touches and went above, showing you that the 50 was working as resistance. It goes up. This is the first candle that breaks. So we're going to buy here. Our stop loss a few pips below this breakout candle, and our take profit above. Maybe it was gonna be more above or a lot less, but this is the strategy, guys. So we said the conditions need to meet, right? The entry rules, the stop loss targets, and the take profit, right? You need all these things to match so that you can create a high probability trade. So this is a moving average strategy with the breakout. Note that you are not always going to get winning trades with this, but you are going to get a lot of good trades if you really follow it, because the win rate is over 50% and the risk to reward is also bigger than 1 to 2. So this strategy is a very good one. Take a look at the last example here. So we see the market moving above both moving averages. The 20 is up here, the 50 is up here, meaning we are going up. We see a pullback that comes into the 20 or between these, but no trade closes below the 50. no candle closes below the 50 and the market starts going up again, and now we are paying attention to this zone. Once the market goes and breaks above, we now buy, and we put a stop loss a few pips below this breakout candle, right? Because what we know is if this zone, if the market goes up and breaks above here, if it reverses, remember we said from our early videos, this zone is likely to become your support, because here it was resistance, right? So the market, it was our area of value. So it might be, this might be become a medium pullback. So if we buy at this breakout, we want to put our stop loss below the breakout candle, which is below this zone. So if the market comes back here, this can help us again to push prices up. And that is one of the reasons why I think this strategy has been successful, right? So hopefully this was clear enough for you to understand. I don't know if my drawings was all over the place, but I think if you really follow through with this video, this was easy to understand. You can go ahead and test this strategy, because you, as you already have the strategy backtesting journal, test it and see where do you want to use it, right? I like to use it in 1 hour time frame, also 4 hour time frame, because the market tends to move with less noise in those bigger time frames. So in the next lesson, I'm going to show you how to use another indicator called the alligator to place another high probability trades in the market. So let's go into the next lesson and let's talk about the alligator and how you also can use this same concept but using another indicator to place high probability trades.